What is the stock market? In this video, I'm going to make it simple and easy to understand so that anybody watching this video, including you right now, will understand what the stock market is after watching this through until the end. The way I'm going to do this is I'm going to read out a statement on the stock market, explaining what it is. Then, after I've read this to you, I'm going to break this down so it's simple and easy to understand. First step is for me to put my glasses on so I can read out this statement. A stock is a type of security that represents ownership in a company. When you buy a stock, you're essentially buying a small piece of that company. This ownership comes with certain rights, such as voting on company matters and potentially receiving a portion of the company's profits through dividends or capital appreciation. Ownership. A stock represents a share in the ownership of a company. Earnings and assets. Stockholders have a claim on the company's earnings and assets. Voting rights. Depending on the type of stock, you may have voting rights in company decisions. Dividends. Some companies pay dividends, which are distributions of profits to shareholders. Capital appreciation. The value of a stock can increase over time, leading to capital gains. Stock markets are places where stock are bought and sold. The price of stock is determined by supply and demand. If more people want to buy a particular stock, the price will tend to go up. If more people want to sell a stock, the price will tend to go down. So let's break this all down so that you understand exactly what the stock market is now that I've read this all out to you. Now, your ownership of a stock in the stock market. Let's say you have purchased a Microsoft stock. You may receive dividends depending on the type of stock that you've purchased. This isn't always the case. Remember, there are different types of stock you can purchase on the stock market, and they give you different rights depending on which stock you now own. This is digitally purchased, and you will purchase this usually on a stock market, for example, eToro. Capital appreciation. Now, this is usually what incentivizes investors or small beginner investors to make a purchase. Normally, you're looking for a return on your investment. What this means, let's say you bought a share in Apple. That share, you can see the stock price. You bought it at, let's say, £1. You want that stock to go up to £2. So that means you've made a profit. It is now worth more than when you purchased that stock. And usually, as a beginner investor, this capital appreciation is usually what incentivizes a small to beginner investor to make a purchase of a stock on a stock market. You're looking for that stock to change price. This isn't always the way you earn additional income when trading a stock or purchasing a stock. You can sell your stock. Let's say you've purchased a stock on a stock market website, for example, eToro. When the price goes up, you might want to cash out your profits by selling that stock back to the stock market so that you can collect your profit because it has now gone up in price, meaning that you have your return on your investment. A return on your investment is you've invested in some stock by making that purchase of the stock, and you are looking for a profit or a return, which could be dividends. Dividend payouts can be different, and this can vary depending on the company's activities. For example, how much profit it's making during the time of that dividend being paid. Voting rights aren't always available to you. Just because you own a stock in Google does not mean you will be in a shareholders meeting making decisions for or with the company. It depends on which type of stock you own. So remember that when you're purchasing a stock, even if you own the majority, it depends what type of stock you own. People get confused when you use the terminology stock or shares. Your stock represents your share in the company. You purchase the stock, and that is your share of the company. So you can have more stock, meaning you have more share in the ownership of the company. A majority shareholder technically owns more of the company. What I mean by majority is, let's say someone owns one stock. There are only 100 stocks in rotation. I own 99 stock. That means I have most of the stock. I'm the majority shareholder. So when you have a shareholders meeting, that is those people who have invested in that company, that own stocks, majority shares in the company, and they are meeting to make those decisions on the company's decision to move forward with something or make a change within the company. This is what is happening a lot of the time with very large companies when you have that specific stock. Remember, depending on the type of stock that you own, will give you different rights towards what you have in the company, what type of voting rights you have in that company. Remember, there are outside factors that may influence investors to buy or sell. For example, if the company's future is not looking good because they've had some controversial news about something that may affect the company's future to earn profit, this could essentially stop investors purchasing or wanting that stock, which could drive the stock price down. This is in theory, but isn't always true. But it could be an outside factor you could pay attention to because it could influence investors, which could change that stock price. Because stock price is based on supply and demand. It depends how much stock is available and, of course, how much people want that stock. That's how the stock price changes. It depends on the investors. You have large investors and you have beginner, small, and medium investors. Depending on which type of investor is interested, this again could change that stock price. There are some millionaires and billionaires that tend to invest in specific companies. This could take up a lot of the shares that are available in the ownership of that company, which could theoretically make the demand or supply change with that stock. Which is the reason why large investors can change the stock market trends depending on what they're interested and are investing into. If you have a large investor, this could be brilliant for your company. But smaller investors in large numbers can also have this effect. These are all theories and things that, of course, could influence the stock market. Could is the key word. To make this even more simple, a stock market is a place you go to purchase ownership of a company. You can purchase different types of stock which give you different types of ownership rights. For example, those voter rights and, of course, those return on your investments, those profits, that money that you can make from owning a share of that company. For example, dividends, which is paid out to you by the company. Dividends is another factor that can influence an investor to make a purchase of that company or part of that company, the share ownership. Different stock market sites show data in different ways. Although you have the generalized stock market showing you the prices of that stock, and you can see that usually live, you also, on some stock market websites, can find other data that can be helpful for you to make good decisions on your purchases and when to sell and stop owning that stock. As when you sell that stock, you no longer own it. You have collected your profit or loss depending on the time that you sold your stock. Ideally, you want that profit. Remember, you can own a stock over a long period of time or a short period of time. This is up to you when you sell and when you purchase your stock. This is why your security when purchasing stock is very important. If you lose access to your stock, you can no longer collect that profit from that stock. For example, your dividends, which is your returns on your investment, which are quite frequent depending on the type of company that you've purchased that dividend stock from. This could be monthly payment that you are collecting. If you don't have access to your account in order to get to that stock profit, then you won't, of course, have access to your portfolio. This can also be a huge negative depending on where you're purchasing your stock from. Make sure that you have everything secure when you are deciding to invest any money in the stock market. Your password and security are very important. This is entirely done online, and remember, online safety is very important when you are spending or earning your money. So remember to stay safe when you decide to invest in the stock market. If you've enjoyed this video, there's a lot more where this came from. You can find these types of videos in the online money playlist on my YouTube channel. I also teach you how to create accounts in various fintech apps, which can be extremely helpful to you if you want to earn money online and sometimes offline. Check those videos out that you can see on screen right now. And thank you for watching. I'm Anthony Allen. I'll see you in the next one.